The British pound has been remarkably resilient against the US dollar strength since putting in a 5-month high on December 28th. Now, since that time, the pound has lost 1.6%. Compare that to the 3.5% lost by the euro and the 5% lost by the Swiss franc. The narrative is straightforward. The market's belief is that the Bank of England will only ease by 75 basis points this year compared to the 100 basis points expected of the Federal Reserve in response to more persistent inflation pressures over there. The basis of belief is that the inflation is more of a problem in the UK, with their latest read of CPI coming in at 4.0% for December versus the US December read of 3.4%, and then came the US January read of 3.1%. Now, on February 14th, we have the latest reading of UK CPI, and expectations are for an uptick to 4.1%. Now, the pound versus the dollar will be highly sensitive to the new inflation data, as we saw after the higher than expected US print on February 13th that caused the pound to lose 1% moments after the release. Now, the CME Group offers 3 different size currency contracts, the standard, the mini, and the micro. In order to match a trader up with their preferred risk tolerance, we're going to be using the micros for these examples. If a trader believes that the British pound could move higher from here, they can express that by buying the March micro British pound futures contract at 1.2600 and targeting a move back to the January highs of 1.2800. A stop for this trade could be placed below at 1.2450. This trade can make $125 if the target is reached and risks $93.75 if you're stopped at your level. That's per one lot. Now, if a trader believes the British pound could fall from here, they could express that by selling the March micro British pound futures contract at 1.2600 and targeting a move to the November 10th low of 1.2200. A stop for this trade could be placed above at 1.2860. Now, this trade can make $250 if the target is reached and risks $162.50 if you're stopped out of your level.